Hello, and welcome back to our podcast series, Banking on Primacy, sponsored by our friends at Chime. Fintech as an employee benefit. The idea that employers can act as distribution channels for consumer fintech products has always been intriguing, conceptually. Customer acquisition in B2C fintech is hard, so the notion that you might be able to sidestep that difficulty and expense by partnering with employers to distribute your products to employees has obvious appeal. The problem is that it's much harder to do in practice than it seems like it should be in theory. Employers don't care about fintech. They care about employee productivity and retention, which means that anything that they choose to invest in the realm of financial services, needs to clearly translate into improved productivity and retention outcomes. This necessitates a fundamentally different approach when trying to work through employers. They don't have the budget to pay for employee financial health solutions. They don't have the time or internal resources to build or assemble the solutions themselves. And they don't have as much influence as you might think when it comes to driving employee adoption of employer-sponsored financial services. What this means in practice is that any employer-integrated financial services solution needs to be plug and play. It needs to clearly deliver on the metrics that matter to employers, and it needs to be delivered by a brand that employees will trust. To talk through all of these ideas, I was thrilled to be joined in today's episode by Jason Lee, Chief of Chime Enterprise, which is Chime's employer-facing business division, which was established after Chime acquired Jason's last company, Salt Labs. As you will hear in our conversation, Jason is an expert in all things relating to fintech as an employee benefit, having founded and led one of the first earned wage access providers in the US. He is a passionate advocate for this model, but he's also one of its most insightful critics about how it can go badly if it's put into the wrong hands. I'm grateful to him for coming on the podcast. So without further ado, here is episode 3 in our series, Banking on Primacy. All right, Jason Lee, thanks for hopping on.
Alex, it is always a pleasure to spend time with you.
You're too nice to say that. You and I have had, I think, versions of the conversation we're about to have several times over the years. But of course, fintech never sleeps. Things continue to change and evolve. So I'm very much looking forward to talking to you about what I would sort of think of as employer-sponsored fintech. And we're going to get into what that means and how it's evolved and what's happening in the space. But before we do, I'm hoping you can give just a brief background on yourself, because I think your journey in fintech in some ways parallels some of the themes we're going to be talking about.
You bet. And again, thanks for having me on. As you know, I'm a huge fan. I started this journey in financial technology and entrepreneurship. Well, I'm really going to date myself here, Alex, back in 2015, where in my basement, I founded a company called DailyPay here in New York City. And we were really the pioneers of this crazy new category that's been created called earned wage access. It's a funny product. It's a fintech product. You have to know a lot about finance and structured credit and payments, but we market it to HR leaders and to payroll folks and to operations folks, really as an employee benefit. I ran the company for, just about 7 years. We got it to be a multi-billion-dollar company, and then my partners and I exited to a group of investors fully. And then against everyone's better judgment, we said, well, let's start another company. And after about 3 weeks, I think, of doing nothing. And so we started a company called Salt Labs. DailyPay really modernized or really rethought how frontline workers earn. Salt Labs was modernizing how frontline workers get rewarded. And that was really the concept behind Salt. And we ran that for about 2 years. At which point, the folks at Chime actually came and said, hey, we would love to maybe join forces and have you part of the platform. And so, I wasn't looking to do a transaction, but they acquired Salt Labs about after 2 years of us having the business. And now I look after really what our new enterprise effort is here at Chime. It was thrilling to be part of the story that was ultimately our IPO story.
Yeah.
And now we're out there really trying to partner with best-in-class employers to bring financial health to their employees.
Excellent. Okay, we're going to get into exactly what that means and what that looks like. But I want to ask a broader question to start, which is this notion of distributing financial products through employers. And obviously, like earned wage access, I think was a very early example of this that got traction. This is an idea that's been around for a while in various forms. I like to joke there's no new ideas in financial services, right? So like this is not a new idea. And it's always been, I think, really intriguing to builders, founders, companies in the space for lots of reasons, not the least of which is direct customer acquisition is really hard, as anyone who's ever tried to do it knows. And so this idea of like working with employers, there's like natural incentive alignment. It makes a lot of sense. The theory is great. In practice, it can be very, very challenging. And I was hoping to get your take on like why that is. And in particular, like bring us inside the minds of these employers in terms of how they think about their employees' financial lives, the importance of reducing financial stress, and like how traditionally they have engaged with different fintech companies or banks or other providers to reduce that stress.
So there's a lot there. Maybe the first thing I would address is really concurrence with this idea that, hey, we can just go to the employer and we'll get all of our customers.
Right.
That looks very good on a PowerPoint slide,
yes.
Or on a to all memo. But in practice, it's very, very difficult. I always tell younger entrepreneurs,
Yeah, of course, that we're young, Jason. Just to be clear to listeners,
I want to make sure I clarify that.
Yeah.
But I always tell folks, look, B2B2C is an enormously powerful, just an amazing acquisition vehicle. But it is so hard to do. And there are only very, very few companies who have actually succeeded. It's not, the gym giving you a 10% discount or the pizza store giving you a free slice of pizza. You really have to figure out how do corporates, how do HR leaders, how do CFOs think about their existing motion of how they interact with their workforce, and then graft on top of that your own product's motion. That is a non-trivial exercise. If you can get it to work, oh my goodness, it is so powerful. But absent that, it is very, very challenging. So number one is I would completely agree.
Yep.
How did we do it, or what's worked? I think the best way to think about this is, and it's cliche to say, but one really has to think about this not from one's perspective, but really from your client, customer, or partner's perspective. They don't need financial products. Let me just say that one more time. I know this is a fintech podcast, but the reality is an employer does not wake up every day thinking about, I want a fintech product. For that matter, a banking product. For that matter, a financial services product. That's actually not what they want. What they wake up thinking about is outcomes. They're really waking up and thinking about, I have this issue where employees are not showing up to work, or I have this issue where this is happening. I'm looking for an outcome. That's really what I'm looking for. And that's very, very different than I think the way that some people think about even your question. Hey, it's so alluring to think about doing financial products. We don't really think about our business that way. What we think about is we've identified a key input into an employer's level of productivity, and that is our employees advancing financially. And so our platform really is designed around that. The whole you're a bank, or excuse me, you have banking products, or you're a banking application, or all of these things. We don't really identify like that within an employer. We identify more as we really just want to invest in your employees' financial health. And that's really what we're after.
Got it. Okay, so let's dig into that for a second then, because I think what you just described makes sense. You're actually preaching to the choir in terms of like, please stop saying why this is important to you and start talking about why it's important to the other party you're trying to partner with or sell to, right? Like put yourself in their shoes, what they care about. So obviously, as you mentioned, like they care about productivity. They care about employees showing up to work. They care about employees being productive when they're at work. They care about how long employees stay, employees of the company, right? All of these are things that have a tangible bottom line impact on the business. Help me understand the relationship between financial health or financial stress and those metrics that employers care about.
And maybe just to kind of clean up and further that thought, Alex, before I get there, I think the other, and look, I know everyone is talking about AI right now, but for a moment, please try to remember what the era was before AI. It was the cloud. And what the cloud really unlocked was an ability for us to provide services and goods in a highly asset-light framework.
Sure.
So when we think about, and it's cliche to say, but the largest car company owns no cars. The largest lodging company, Uber, the largest lodging company owns no hotels. It's because the cloud enables us to deliver the result or the outcome of those things without actually incurring the asset cost of owning the underlying asset. For a gajillion years, we thought the only way to be in the lodging business was to own the lodge, or we thought the only way to transport people was to own the car. But now the cloud enables us to completely avoid or enhance or disrupt that way of thinking. Chime's no different. Employers want their employees to be financially healthy. The old way of doing it was, okay, let's get a 401k or a bank and let's get in there and do a drive for, you should sign up for this banking product. I mean, as we all know, Chime's not even a bank. So we're actually delivering this financial outcome without having the asset infrastructure that has historically been the case, be it Uber, be it Airbnb, and now be it Chime. The way that employers now interact with that relationship is they just care about the outcome. One more time, 1000% what they care about is, does that person have more savings in their savings account? And this ain't no rocket science. It's very simple. If an employee feels like, I used to have these jobs and I never advanced financially, now I have a job where I could see I have $300 of savings. Well, guess what? This is the job I'm going to stay at. It's real simple.
Sure.
It is as simple as that.
Mm-hmm.
By the way, the product that I invented, earned wage access, even that's not even the result, meaning earned wage access is just a means to save, to improve one's credit. Like, that is also just a means to an end. It's not the actual end itself. And so the point that we hear from employers time and time again is, okay, you guys do what you're doing, but what I want to see is, I believe that if my employees could actually go home on Friday night and they see, hey, last week I had $84 of savings, and this week I have $144 in my savings account, well, progress is being made. That's real progress. And that's how they equate. Hey, that's good for our business. Chime, you do your thing and enable or unlock that ability for our employees.
Got it. That makes sense. And then the other thing I wanted to just clarify or ask about a little bit is, we say employers, and I'm guilty of this as much or more than anyone. And sort of like, that's one word describing one big block of companies out there. Obviously, that's not true. The size of company, the industry, all of these things matter tremendously. My read of the market is that, and this is true sort of across whatever vertical or whatever sort of domain you want to look at, there's always sort of a couple companies at the very top that operate a little bit differently, right? So like mega, super large employers have for a very long time invested a lot of resources in building out financial health tools or financial services to help sort of address these problems. If you have the scale and the resources, it just makes sense to do a lot of that work and to have been doing it for a long time. To help me understand, like, as you go down market to even very large employers, but not like a Walmart, Amazon size employer, or if you start to like go into different verticals, right? I mean, I know, for example, like fast food restaurants have a very sort of unique dynamic in terms of like workers, retention, hours, all these things. Can you sort of paint a picture of like how the challenges start to be a little different, or the nature of the outcome and how you get to it changes a little bit depending on the type of employer?
Well, look, not to use a terrible analogy, but Willy Loman said, "Hey, the biggest banks have the most money," and he was a famous bank robber. And so, What we are after is where are those personnel and workforce challenges, where are they most acute?
Yeah.
And in the United States, those issues tend to be very acute in frontline workforce employers. So yes, I'm sure IBM and Goldman Sachs would rather people not quit, but the reality is it pales in comparison to a Target or a supermarket chain or whomever it might be, who might be suffering 50, 75, 100% turnover on an annual basis. And so point number one is I kind of bifurcate employers in that direction. It also happens to be why Chime offers this product. As
I was going to say, there's a fit there. Yeah.
There's overlap with our key demo. And, it's April. We're recording this in April of 2026, but we actually just launched a new product to even go further up market. But it really is still kind of the under $100,000 a year type of segment. And so that really tends to be our sweet spot. It tends to correlate very, very highly with higher turnover industries. So I would say, number one, what type of workforce are we looking at? And we tend to major a little bit on the front line. Once you're in the frontline workforce, then it really becomes, okay, what's going on specifically in each of these, what I would call broad-based sectors? Let me give you a great example.
Sure.
And here, this is where I think Chime really excels in terms of really understanding what's going on in the macroeconomy overall and how that's impacting our strategy. We spend a lot of time in healthcare. Why is that? Well, right now there's a aging population problem because the baby boomers have all gotten older, but there's also been secular decline in the number of healthcare services professionals who are trained and able to support them. CNAs, nursing assistants, senior assisted living, home healthcare for drug administration, medication administration. That's an industry of millions of people.
This is like one of the hottest parts of the employment market, right? Like,
100%.
The demand here is just like, I've heard it described that the economy is basically AI and like healthcare for an aging
services.
Population. Yeah, right. Yeah. Exactly.
And so we have that issue. So guess what? I spent a lot of time at these types of organizations because they are desperately looking to have people work because the aging population is an inexorable phenomenon and people are just getting older. And we had that boom from the baby boomer generation. So that's like one example of how we might treat and prioritize a little bit differently. Of course, as a company, we also have to run our business. We know where, and we know the types of folks who love Chime. We love to say everyone does, but some people love us a lot, love us a lot.
Yeah.
And so of course we are shading our business and our prioritizations around those types of segments.
Mm-hmm. That makes a ton of sense. So let's talk about the product itself. And obviously, you mentioned we've touched on rewards, we've touched on savings, we've touched on earned wage access. Like if you were to describe kind of holistically Chime Workplace as an offering, what are the major components of it? How does it work? And then obviously we'll dig into some of the specific components in a little bit, but give us the broad strokes.
Pay bills on time, save, build credit, develop good financial habits. Now, those are 4 things that we offer. There's a whole variety of features and functions, but really, if I'm at a dinner with a bunch of CHR, chief human resource officers or chief people officers, that's how I describe it, which is, look, we do 4 things. We get people to pay their bills on time. We help them do that. We help them save. We help them build their credit scores. And we develop core good financial habits. Now, there are really 2 things that are going on within a given workforce. Number one, it's this notion that people's needs change over time, meaning we want to be with them on a journey. Someone who may never pay their bills on time sees our earned wage access product and they start doing it. But then guess what? They actually are paying their bills on time. And unlike a point solution or a monoline, well, we've got a place for them. We're like, hey, go to the next step. Like,
Yeah, you've
hey,
done this. This is congratulations. This step is now going better. What do you do next?
and now it's doing high yield savings. And by the way, in my line of work, you would be amazed at just how many awful savings products there are that are distributed through employers. You'd be shocked. The vast majority of them pay zero interest. Let me say that one more time. Pay zero interest. And we pay market leading interest, depending on where the rates are, but 3+%. Well, you did that. Let's make your money grow. Let's make your money go longer. Let's use credit. Let's have you start building credit. And all the while using our technology, our prompts, our AI to develop good financial habits. That's one example. But here's the other reality, Alex, is in a given employer, the needs are also very different. Think of it like a racetrack. Everyone starts at a different point in the racetrack. Meaning, I started in the earned wage access industry, of course, but the reality is only 1/3 of an employer really needs that product. To say it again, if you were to ask every single EWA player out there, they'd all tell you the same thing. If not, you can challenge them. It's usually something between 30 and 40% of a workforce need this product and use it. What about the other 60%? How can we roll out a product or a program that only addresses 30% of the population? Well, guess what? What we've determined is that another third, they're fine paying their bills on time, but they've defined their next financial step as savings. And then, by the way, we figured out that another third, they're fine paying their bills on time. They actually do have savings.
Sure.
But what they want is they want to buy a house one day. They want to get a car. So we help them build their credit score. So everyone kind of has a different starting point. And in my line of work, it's important to be able to represent to a CHRO, you come to one place for everything. And you don't have to hire 3 or 4 different point solutions to accomplish this.
Right. Well, and then that kind of goes back to these chief people officers, these chief human resource officers. They're not wanting to moonlight as fintech builders, assembling their own stack of different providers. So again, hard for us to imagine in fintech that you wouldn't want to spend all your time just assembling all the components and building your own stack. But for people who are busy and have 19 other hair on fire problems they have to solve, I could see one provider sort of providing a comprehensive solution being really appealing. Let me ask one just dumb question, and forgive me. What does this feel and look like to the end employee? Because that's the other thing I have a hard time sometimes imagining with this is again, whiteboard theory makes sense. I get it. It's all great. On the ground, how does someone experience this? And, obviously the implementations are all very different. Employers are different. The systems they have in place are different. So recognizing that there's lots of variation, give me a representative example of how I would experience this as a frontline employee. For most Americans, their primary bank account is their most important financial relationship. Traditional banks held that position, and they took it for granted. Chime was built differently. Fee-free, built to succeed when members do, and now America's #1 banking choice with roughly 10 million active members. Chime Prime takes that further. 5% cash back, savings rates up to 9 times the national average, premium travel perks, and no fees. See how at chimeprime.com.
Let me start with the base, which is right now you, Alex, and all of your listeners, you can go to the App Store, download Chime, and you can get exactly what I just described. You can get a working earned wage access product. At Chime, we call this MyPay. You can get that product. You can take advantage of our savings product. You can also use our credit building product, and that is the consumer experience. So what's different with the employer? Why are we here? Why am I here? What we do is we create a higher fidelity experience for those basic products through that data integration. Perhaps in the earned wage access MyPay product, it's based on your past paychecks and you're a consumer and here's $100 and it might look like that. Well, if I'm now connected into the core HCM or core time and attendance system, which is where we traffic, well, now all of a sudden I know precisely what you've earned. You've earned actually $455.34. And that execution is a lot higher fidelity for the employee. It feels frankly less like a cash advance, and it feels more like real-time earnings. On the savings front, we have the same thing. When we work with a large employer, we actually enhance the savings yield because we are connecting to the HCM data. We are able to say, you know what, this person is probably going to be here for a long time. Let's create more savings incentives. Let's say, hey, if you're saving for another 6 months, we'll put in X dollars, or we'll do this on the yield. So there's just greater incentive. We have a loan product here, at Chime, and that gets offered to people who sign up for the card as consumers. But within the employer context, imagine how that gets really turbocharged, because now we have a payroll lock, we've got pay history. So a lot of what we do is creating a higher fidelity data layer, and we create that interoperability across all these different systems. And that enables us to offer a superior product to employees of our employer partners relative to what they could do, by just, downloading the app on the App Store. By the way, we love that. The consumer product here is amazing. 9 million people or whatever are using it. But that is really the value that we bring on the workplace side to the employee.
Got it. And then just in terms of like kind of branding and access for that employer product, like what does that look and feel like? Is it still Chime? Is it like something that I'm accessing or getting like sort of made aware of through different internal systems? Like what's the experience layer look like?
So they'll find out about it through their HR departments. And so I know that in the world of AI, doesn't this sound so old school? A bunch of posters go up, a bunch of.
I got to tell you, man, I'm becoming so much more old school the older I get, and the more I'm getting rushed into this future of AI. So keep talking. Posters on the wall, and like,
table,
the
table
like the water
toppers.
cooler. Yeah.
Yes.
I got you. Okay.
And believe it or not, it works. It still works. And obviously we do partnerships with HCM companies. So you might see it on your time clock or in your pay statement. That's how they find out about it. But the experience and the brand is identical, meaning they're still going to the App Store to download Chime. We have some UI UX which identifies if you're an employee.
Sure.
So that kind of sticks you into this thread of our app. But the point that I would draw to is it's Chime. It's a brand that you trust. By the way, you may have it on your phone already.
Sure, yeah.
You may be an NBA or an MLS fan or a WNBA fan,
I got you.
Or a Portland Fire fan, or we just announced a big deal with the MLS. You may have heard all of these things, so you trust. You at least are aware. You probably have a friend who's used the product. And that is just massively leveraging for the HR department. Having done HR for as long as I can remember now, the biggest challenge that HR leaders have is explaining what is this benefit that corporate signed up for.
Right. And like, what is this thing that you're now telling me?
Right.
I've never heard of this thing. Like this thing might be big among HR leaders.
Exactly.
But an employee won't have heard of it. Okay. That makes sense.
I mean, imagine Michael Scott trying to explain what Jan and David Wallace, it never worked.
Right.
That makes sense. So the concept is don't explain it. This product is self-explanatory. And that's entirely leveraging because they already know who we are.
Right.
You put a can of Diet Coke on the counter. Nobody says, "What do I do with that thing?"
Right.
What is? And Chime has spent the last 13 years building an amazing brand that I don't even know what we disclose publicly, but I'll just say a massive number of people are aware of. That really helps HR departments. It's one of the reasons why people work with us is so that they don't have to do that work.
Yeah, that makes a lot of sense now that you described that, because and it kind of goes back to what you were saying about like bad savings products embedded in these places. Like one of the reasons I think that exists, and it's interesting, it's like if you only sell to HR folks, then as long as your reputation is good with HR folks, it doesn't really matter the rest. Like the rest of that doesn't matter. Like as long as we can sell to the HR leader, and I've been in enough like B2B sales over the years where it's like these B2B sales sometimes are like, let's go play golf and then go to a nice dinner. Like as long as we can win that deal, however we have to win it, the rest of like the product and its impact on the brand and how employees experience is not necessary to win. It might be nice, but it's not necessary to win. Whereas it sounds like the way you're describing this model is everything is reinforcing off of the product and the brand association with the product are why you win and what needs to be strong. And that creates this like feedback loop.
You can have the tree fall in the forest, meaning the number of HR leaders who will tell you this directly. Well, I picked this benefit, we rolled it out, but no one signed up. And we realized we wasted all this time. And that was very frustrating for us. That tree is falling in the forest, meaning that HR leader did exactly what you said. They had that dinner. They played golf. They had 4 meetings, Zoom calls, Teams calls. They got comfortable. But all of a sudden you're rolling out sphinxsavings.com. Employees are like, what? That sounds like a riddle. I'm not going to do it.
Right.
Or whatever. And so,
what is this thing? Yeah.
And not only that, I'd say the vast majority of these products within the employer context are non-portable.
Right.
And oftentimes, oftentimes people say, well, I would like to save, but I also really don't like my manager and I'm quitting in two weeks.
Sure. Yeah.
And so, I'm not going to sign up for it. And so Chime is obviously portable. You take your time wherever you want.
It's interesting. I mean, and we're sort of, not talking about AI in this episode, but I just happen to have had a recent experience where it does remind me a little bit of AI, where it's like, hey, I use this AI chatbot or agentic system. But now the next time I log in, I find out, oh, my employer just signed up for the enterprise plan for this.
Right.
And it is interesting as a parallel because it's like, I was already using this. I'm already familiar with this. It's portable if I change employers or go somewhere else. But because my employer is doing sort of the premium version of this, I get like the super powered context rich version of this thing that makes it even better. And so I think that model makes a lot of sense. Let's drill into earned wage access for a second.
Sure.
Your home, the thing that you started with, this has been a very successful product. And I think in some ways kind of built the modern version of like employer distributed financial services, right? I mean, this is like the product that's kind of the cornerstone of that entire strategy. And it's interesting because I think at a high level, people think like EWA is EWA is EWA. And it's only when you dig into the details that you sort of find out like all EWA products are not built the same. They are not integrated the same from a data perspective. They are not distributed the same way from a customer acquisition perspective. They are not regulated the same way from a compliance perspective, and they are not monetized the same way from a business model perspective. And all of those distinctions actually, I think, matter a ton to like the quality of the product, the outcome, again, getting to the theme of this episode, the outcome that it drives for the employee that's using it. So give us a little window into some of the key differences between products in this category, and then like sort of what you've learned building in that space, and quite frankly, like selling it to HR teams and getting employees signed up for it.
There's been a lot of evolution in this thing since I started it in 2015. I would say, I'm going to be a little bit crude, but when we started it, it kind of was a paycheck advance replacement. And just very candidly, that's how employers thought about it. They were like, gosh, golly, I hate when people ask me for this. I don't like to cut out, it's very complicated. You have there's withholding tax issues. There's all this stuff. And gosh, golly, boy, and this is back in 2017. Boy, you guys will do it? Yeah. Great. Outsource that.
Yeah.
Sometime around 2018, 19, we at DailyPay, one of the leaders of this, kind of said, this can be thought of it more as an employee benefit.
Sure.
And there's some reasons why that would be the case. And then of course, during COVID, it completely went bonkers during COVID for a whole variety of reasons, like everything did. Okay. So The evolution that I'm getting at is, where are we today? And by the way, there's the canonical piece of literature on this is a group called the Everest Group. It's an HR research firm who just published on this, I think 2 months ago. The way that I would characterize or summarize that entire report is, when employers ask for EWA, they're actually asking for financial health. So one more time, and let me give you a great example. We got an RFP from a very, very big company, and there are 104 questions in that RFP. 24 of them were about EWA. Now, the RFP was called the EWA RFP. So it was called the EWA RFP, but only 24 questions had anything to do with EWA. And I share that story to say, it's kind of become this catch-all phrase for, we want to invest in our employees' financial health. So I would say that, observation number one is, where we are today in the EWA market is, if you ain't bringing financial health in a real way, not check the box, I'm saying best in class. Best in class EWA, cool. Best in class savings, best in class credit building, best in class financial education, not check the box. When I look at our book of business, only 20% of it is purely EWA. The other 80% is all this other stuff. And so this industry is morphing into the financial health industry. That's really what's occurring. So that's observation number one, which is, how has EWA changed? It's changed in that the aperture has really widened. As it relates to EWA specifically, yes, like for those of us who are in this industry and for those of us who are unfortunately cursed with having this on our business cards, there are some distinctions that have started to emerge. Most of it is only stuff that EWA people are like ticky-tacky with each other about, and like, oh, we're potato, 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 potato. But I would say that, yeah, there's probably some broad-based distinction between really the two that I would point to. Is number one, is it fee-bearing or non-fee-bearing? What I mean by that is, like, in a lot of the legacy models, those models really did rely on, including the one I built, relied on, hey, take your money, we charge you a fee. The technology and business models have so evolved, including at Chime, where that's not really how people make, it's not really how we fund that business anymore. We actually give it away for free within the employer context, because all we're looking for is a longer term relationship with that end member, and that subsidizes and funds the entire business. I would say this fee thing, if I had to pick one issue, this will determine the shape of this business going forward. Regulators are very focused on it. The New York Attorney General literally has a lawsuit against a few of the providers, and by the way, some of whom are based in New York.
Sure.
Like when your state regulator is suing you, there's a real issue here.
Yeah.
And it's there's class action, there's this, and it all kind of, look, you can cut through the legal arguments, but those are all just tortured. It's really just, I don't want to pay a fee for this. And people will reverse engineer an argument for, I don't think we should pay a fee for this. And that's really and you'll never win based on some tortured legal argument. No one's interested in Harvard Law School. What people are interested in is, well, are people suffering or not? And can this be provided through a third party at no cost? And if so, then you should do that.
Well, it's interesting because to your point, and this has been kind of a theme in this series, actually, I think there's this idea that like this is sort of always how it should have worked. And it was weird that it didn't work this way. And this thing is correcting for that like sort of historical accident or aberration. And as such, it is almost sort of like difficult. And I think this is a good thing from a consumer perspective. It's difficult to sort of justify an explicit fee for it, or it's difficult. The one that drove me crazy in the past, and thankfully it's mostly receding now, is like, it's difficult to justify asking for tips for this. Like, I think that in some ways, and I think earned wage access is a good example of this, like employees should be able to stream their wages or a portion of their wages. And it was kind of silly that they weren't able to. And it was an artifact of technology and payroll system design and all these things that like probably shouldn't have ever been the way they were, but they were. And this is kind of correcting for that. So I do think you're right. Like if you look at the arc of history of how some of these innovations play out, and Chime has actually been at the center of quite a few of them, which is interesting. It's kind of just like, well, this is silly. It should work this way instead. And part and parcel of that is like how you package that, how you subsidize that, how
That's
you make
right.
money from that.
I mean, on this narrow point of fee,
Yeah.
I view the world very simply. You can either try to change the law or you can change your code. It's real simple. You can try to change the law or you just change your code. China's taken the approach of, no, we'll just follow all the laws and like, this is the product that we offer. And we will engineer around that in our business, in our code, in the products that we offer. I think this particular industry has taken a bit of a unique position in trying to change the law and or frankly pretend it doesn't exist.
Sure. Yeah.
And I don't look. I can only speak for myself. I don't know if that's going to wind up in the right place because try to take your family out to dinner. You can't even get them to agree on the restaurant, and there are vociferous points of view in this country about every issue.
Oh yeah, for sure.
Including, believe it or not, this little thing that we created in the basement.
Oh yeah. I mean, yeah, the sort of normal non-fintech listener might be surprised to hear that. I, as someone who pays attention to this stuff, know it is like quite the argument that's happening all across the country right now. Now that position makes sense. Before I let you go, let me ask you about like a little passion project of mine and get your take on it, which is,
please.
And it's kind of thinking about like where all of this goes and how it evolves. One of the things I have been fascinated with for a long time is the payroll system. And the reason that I'm fascinated with it is from a consumer perspective, it's kind of where everything starts, right? And so like we're all fighting for access to the direct deposit, for a primary relationship. And I remember a long time ago, I created this graphic that still bounces around on Twitter from time to time that was sort of showing like the waterfall of someone's finances and just sort of making a very simple point, which is that like it actually all starts at the employer level with the sort of initial allocation decisions that you make as an employee. And obviously, like that's not a decision that you revisit all that often. For a long time, even payroll systems weren't something that had consumer access built into them. So you would fill out a form when you started up with an employer. They would, figure out your direct deposit and then like, we'll never touch this or do anything with it again. You elect your insurance, all the things. Then we have what we have today, which is, well, now I can access my payroll system. I can log in. I can split my paycheck between a couple different providers. I can, maybe like change some things with like my healthcare allocations or my withholding. And I bring all of this up to say that even though there is some level of consumer access to this, and I think employers are sort of investing in like modernizing some of this stuff, it does still feel strange to me that like the top of the waterfall is not a place where there's like a really great like user interface or consumer sort of layer that gives you control and insight into like decisions that happen there. And I've always sort of had the theory that eventually we will see more fintech innovation, user experience, whatever you want to call it, sort of migrate like up the waterfall and get to that point. And I sort of view everything we've been talking about with employers as sort of a step along the way to get there. What's your sort of larger scale thinking about like where this goes, how this evolves, and like where there are still opportunities to sort of innovate or push the frontier forward a bit in this area?
There are multiple ways to get at that objective, meaning at the end, as you astutely pointed out, for the fintech audience, everyone knows it's the deposit. It is the paycheck. That's the irony. That's the big whale. How do you get it? And what I might just observe, and I can only speak for myself, is notwithstanding how great technology becomes, I have tended to find that corporate incentive really is what drives outcomes and results. So let me give you an example. And this is a trite one, but ADP, well, people used to say, well, ADP, I don't get it. They should become a bank. They got all these deposits, and why don't they do lending and this? And there's a very, very simple answer for that. It's and which people don't understand, which is it's because ADP has existed since in the 1924 or whatnot, and it's done everything it can to avoid being regulated like a bank. Almost so much so that they raised their hand about 10 years ago and said, we will self-regulate under MTL. And the strategy there was, well, someone's got to regulate us. If we don't take control over this, someone else is going to come over and say, but if you think about the systemic significance that ADP has in America or all of these payroll companies, don't you think they should, one could think, well, shouldn't someone be looking at that? The point that I'm getting at is the more, if that's your mindset, which is I'm now the CEO of ADP and
what would I do differently? Yeah.
Under my watch, I do not want to get regulated by the OCC or whomever, non-bank, regulatory supervision.
Yeah.
Well, I will do everything I can to avoid that. So again, while I think fintech entrepreneurs are like, I don't get it. It's so easy. Why wouldn't you do this? It's so obvious. The reality is you have to really understand what's going on at the corporate objective level, at the board level, to understand that's the last thing that ADP is going to do, because they've just spent the last 100 years avoiding that consequence. So I say that as an example to say, I can only speak for myself, but the way that Chime has done it, I think probably is what's going to happen, meaning they've done a great job of not innovating at the payroll company level where stuff could occur, but rather let's have one river that hits the lake. And from that lake, we can have multiple tributaries coming out, as opposed to having tributaries coming from the payroll system, meaning tributaries normally don't come from the ocean. It normally goes ocean, river, lake, and then an output. And what you're looking for is, how do I kind of get as much of that direct deposit in? Once it's in, now let's have a gajillion products in terms of how people can manage that money, as opposed to fighting over it at the payroll level. And I think, Chris, Ryan, Mark, our chief marketing officer, Vineet, what they kind of figured out very early was that brand awareness, that brand power, boy, gosh, it really matters, because that's what enables us to get as close to all of that paycheck. Then you can innovate at the product level.
Mm-hmm. Mm-hmm. That makes a lot of sense. Yeah, I mean, it's this like center of gravity concept, right?
Exactly.
And I think that, the idea that we necessarily can like force a center of gravity to exist where it doesn't naturally exist is a flawed way of thinking. And, you're right. Again, I returned to my statement at the beginning of the podcast, like, none of these are new ideas. And so a lot of times you have to sort of accept like, well, there's probably a reason why it hasn't worked out this way and it's more moving in this direction. So no, that makes a ton of sense. Jason, you've been very generous with your time. I will let you go. Thank you so much. I feel about 1,000 times smarter than I was before on all things employer financial services, employee financial health. So thank you. This was great.
I guess that gets you to quadrillion then. So, but
I wish. There's still more learning to do, but thank you. This is awesome.
Thanks, folks.
Thanks for listening. Today's episode was brought to you by Chime. J.D. Power found that more Americans open new checking accounts at Chime than at any bank or fintech in America, 2 quarters in a row. 97% of Chime members say it's unlocked their financial progress. Chime Prime now builds on that. Expect more cash back, higher savings rates, travel perks, and still no fees. Let your hard work pay off at chimeprime.com.